Pre-market brief, November 11, 2025. Let's get to it.
Okay, the catalyst is clear. The government shutdown resolution. That's our focus. Here's the plan.
First up, top market moving news. The driver today is the shutdown catalyst. So here's the deal. A continuing resolution to end this 41-day shutdown is expected within the next 48 hours. That takes a major headwind off the table. We're talking an estimated $15 billion per week. Now, the damage is done to some extent. You can see Q4 GDP forecasts have already been slashed from 3% all the way down to 1.5%. The real risk now, the thing we all have to watch for, is the imminent data dump of all those delayed economic reports from the BLS.
Now, what does this mean historically? Let's put this into context. The data is compelling.
And here it is. Historically, 1 year after a shutdown ends, the S&P 500 is higher 86.4% of the time. The average gain, a solid 12.7%. So the historical bias is clearly to the upside. Okay, so with that bullish historical backdrop, let's talk about the immediate risks. We're looking at the VIX, that data dump, and what's happening globally. All right, let's look at volatility. The VIX has come in on the shutdown news. No surprise there. It's down almost 8% from 1913 down to 1760. But, and this is important, it's still in a structural uptrend of higher lows. So we're not out of the woods. For me, a move back above 18 is the warning signal. That's the level to watch. Beyond the VIX, there are two other big macro factors on the radar. First, as I mentioned, that delayed data. We're talking about the big ones, jobs, inflation. The timing is unscheduled, so you've got to monitor the official BLS announcements closely. Second, don't forget about China. Their global exports just fell over 1% year over year. And get this, exports to the US were down over 25%. That's a clear signal of continued economic fragility over there.
All right, let's drill down into key sectors and names. It's all about levels and technical posture.
Now, a key factor right now is gamma exposure, or GX. Think of these as potential price magnets due to dealer hedging. For the SPX, your key support is that 50-day exponential moving average, right around 6650. To the upside, we have very high GX at the 6900 and 7000 strikes. Those are the targets. Looking at gold, GLD bounced right off its 50 EMA. It's supported by those debt concerns and is now targeting GX levels at 375 and 380. And then there's PLTR. It held its 50-day EMA as well and has a huge GX concentration right at the $200 strike. So keep an eye on that level. This is a good reminder that a macro theme alone isn't a trading plan. You have to look at the individual charts. Take tariff-sensitive stocks, for example. They're all over the place. CAT is still in a clear, strong uptrend. Meanwhile, GPS is just trading sideways, consolidating below resistance at 2450. That level offers a really clean breakout to watch. But then you look at NKE, it's in a confirmed downtrend. For now, that's one to avoid until you see a clear reversal pattern. And just a quick reminder here, this content is for educational purposes only. We're aggregating public info to help you stay informed and sharpen your own decision-making. So please do your own research. This is not financial advice. Hey, if this is helping you frame the market, do me a favor and subscribe. And make sure to turn on notifications for the new weekly market update playlist so you don't miss out. Okay, let's put this all together into actionable scenarios, our base, bull, and bear cases. The trigger levels are very clear. Here is how we'll know which scenario is in play. The bull case is triggered if SPX clears 6880 and that delayed economic data comes in better than feared. The target then becomes that 7000 GX level. On the flip side, the bear case is triggered if SPX fails to hold 6790 on negative data surprises. The target there would be to fill the price gap down towards 6740. So my base case for today, I'm expecting the market to grind higher, slowly working its way toward that 6900 GX level. But it's probably going to be choppy while they wait for those data releases. The key confirmation for me is seeing the SPX hold above that 6790 to 6800 zone, which was previous resistance. My posture reflects that. Cautiously long, maybe 60% delta, but holding cash on the side to deploy if we get some data-induced volatility. Now let's quickly break down the why behind these scenarios. What are the bull and bear arguments? The bull thesis is pretty straightforward. You've got the shutdown resolution as a catalyst, you've got strong seasonality on your side, and you've got that high positive GX at 6900 and 7000 acting like a tailwind pulling the market higher. The risk? A classic sell the news reaction, or of course, a nasty surprise in that delayed data. The bear thesis, on the other hand, argues that the reopening is already priced in. This sets up a sell the news event. In this scenario, that flood of delayed data actually reveals underlying economic weakness that the market wasn't expecting, and that causes a reversal. The biggest risk to the bear case? The data comes in just fine, merely in line. That would remove the catalyst for a sell-off.
Okay, let's talk about how to potentially express a view here using defined risk strategies. We'll look at a couple of option setups.
Okay, strategy 1 is on the SPX. It's a bullish debit spread with a 1 to 2 week horizon. The thesis is simple. We're targeting that high GX level at 6,900 on this post-shutdown momentum. So the structure could be something like a 6,850, 6,900 call debit spread on a weekly expiry. The whole purpose here is to exploit that upward momentum while capping your risk and really reducing your premium cost. Your invalidation level is clear, a close below 67.90 support. This would be a starter position only.
Strategy 2, a bullish debit spread on PLTR. This is a higher beta play on the risk-on narrative, and we're targeting that $200 GEX magnet we talked about. A potential structure here is a 180 by 190 call debit spread. Again, this helps limit your cost on a more volatile name like this. The invalidation is a firm close below the 50-day EMA. And I have to add this warning. Options are risky. Your capital is at risk and losses can absolutely exceed the premium you pay. You must use disciplined sizing and stops.
If this plan helps you navigate the session, please like and subscribe, and turn on those alerts so you don't miss the next morning brief.
And to wrap up, this is not trading advice. It is just a market update to keep you informed. All markets carry risk, so trade your own plan, manage your downside, and always verify all data. Stay safe out there.